ETFs are a great way to set yourself up for a really great retirement and not have to worry about a financial advisor guiding you on this. So right now, I'm going to run the gamut on ETFs. This is going to be a longer video. You should watch it twice. You're not going to get it the very first time, especially if this is new to you. I'm going to go through different ETFs that you could put your money into that historically get a 10% return over time. I'm also going to show you how you can go into sector-specific ETFs. For example, an airline ETF, a gold miner ETF, etc. Then I'm going to kind of get into the more scary ETFs, the 3-time levered, the ARKs of the world, which I call the wolf in sheep's clothing, and that is where we will go from here. So first of all, let's look at the first one, and this is SPY. This is the most common one out there. It's the S&P 500, and that is exactly what you're doing. You are buying all 500 stocks broken down, weighted into different categories, and it is very low cost. I think that the cost basis on this thing is about 0.09%. So you are really not paying very much from here. Now, the great thing about SPY, it's letting you buy every single stock in the stock market, in the S&P 500, I should say. So you are getting a piece of everything. Let's go down to the holdings. Top 10 holdings right here. So you are getting Apple, Microsoft, Amazon, Facebook, now Meta, Google Class A shares, Google Class B shares, Berkshire Hathaway Class B shares, Tesla, there's your Tesla, Nvidia, JP Morgan, and you can see the asset breakdown of them all. You can go through and see all of the holdings if you really want to break it down, but it's going to give you a piece of everything. Not only that, you're going to get some type of dividend yield. You're going to get the weighted average of the dividend yield that comes out. Now, if you don't want to do this one, you can come over and go to a Vanguard ETF. Remember, let's break this down and look at these holdings. Very similar cost basis, and come down and look, it's almost the same. Apple, Microsoft, Amazon, Facebook, Google Class A, Class B shares, and it is literally almost the same and almost the same breakdown. So when people ask me, hey, what's better? Is it Vanguard or is it S&P? Honestly, I look at it as it's personal preference. There might be a couple of basis point beats to one side or the other, but overall, I look at it and say, you're probably going to do very well over a long period of time buying SPY or VOO. Now, I did a previous video on an ETF called, now let's go look at the prices real quick. Let me pull up SPY because I want to show you this. SPY, you're paying $413 a share as of right now. I want to look at this ETF called SPLG. This is a spider ETF that is smaller. It only costs you $48.50 as of this moment. And the breakdown is very, very similar. There's another video that I actually did a comparison to these, and these are almost identical breakdowns, almost identical holdings and weighted averages. And this one actually costs a little bit less. The cost basis on it is about 0.03%. So if you come down here and you look at it, you notice the breakdown to S&P asset percentages is almost exactly the same, and you have it. Apple, Microsoft, Amazon, Google Class A and B, Berkshire, Tesla, Nvidia, JP Morgan. So you see, there's different ways that you can go about this. Now, what is the benefit to this one? Well, it's only $48 versus $413. So if you, for example, you take $400 a month and you want to go and buy S&P shares. Well, you can't necessarily go if S&P's at 413 right now, you cannot go and buy one share for the month of August. But what you can do is you can go and break it down and you can buy that $48 share, you can buy a couple of those shares. So it gives you that opportunity. Now, what's the main difference? The main difference, and what would make me want to go if I only had that much, go for S&P versus SPLG, is the options. So when I look at options, and guys, if you don't understand these options that I talk about, there's so many videos that we break down what we do as far as selling covered calls and cash secured puts. I'm getting my words twisted. Here we go. S&P. Let's say that we want to, current price is $413. Let's say that we want to sell a covered call on the S&P at, let's see, what price should we go to? What price should we go to? I'm gonna pull up just calls here. So let's go 30 days out, September 23rd, 2022, and let's scroll down here and let's pick a covered call date. Current price is at $413. Let's go to a $450. This thing's scrolling any faster here. There we go. Let's get down to a $450. $450 is going to give us about 23 cents a share, and our delta is about 3%. So the delta means that you are going to have about a 3% chance that this event occurs. So the event that's going to occur is that the S&P 500 is going to be at $450 a share by the September 23rd date. And you are going to collect 23 cents a share for doing so. Now, let me compare this to SPLG. So I'm going to go by a 3 delta. Let's pull up SPLG, and let's just scroll down here and see where we can find a 3 delta on September 23rd. It's going to be September 16th. Let's see a 3 delta. So a 3 delta is going to be it's going to pay us about 5 cents a share. So you see, and the odds are that you actually get this at 5 are very low because there's very low volume on it. But what you can see, and here's your delta, is that you get paid more for SPY versus SPLG. And to me, as somebody that likes to do options, and I know a lot of you do, or you want to get into it, this is why SPY would be better for you in the long run. Now, let's go to some other ones. Let's go to some sector-specific ETFs. One that I like to participate in is JETS. What this is the airline ETF. So let's go and look at the holdings of JETS. We have Delta Airlines, United Airlines, Southwest Airlines, American Airlines, Alaska, what is this? Sun County, Allegiant, JetBlue, SkyWest, and Air Canada. But you can see the breakdown. So let's say that you don't want to just go and buy an SPY, or you do go and buy your SPY, but you want to do some other stuff on the side. You see that the airline business is very, very down right now. What can you go do? Well, you can go right here and buy all of the airlines. Instead of saying, I'm just going to go and buy United Airlines, go and buy JETS. Go and buy JETS for $18 and see where it goes for you. If the whole airline industry goes up, you make money. The whole airline industry comes down, you're kind of protected on that downside because of that weighted average. That is, you're not just getting smoked one time, you just owned 10% of United Airlines, 10% of Delta, and so on and so forth. Now, you could also go into some futures ETFs, USO. This is something people always ask me, what's one of my biggest investing regrets? Especially in 2020, this happened. I bought USO. I did not understand futures, okay? I still don't have a great grasp on futures, so therefore, I tend to stay away from them. But what this is, it's a fund looking at futures of oil in the United States. So if you wanted to, you could go in here and start buying some of these futures, and here's your breakdown. It's going to tell you exactly where it's pulling from. Crude futures contracts is the majority of where it's coming from, and then you go down from Fidelity to Goldman Sachs, futures, etc. These are a little bit more risky, and I need you to understand them before you go and do them. Don't just think oil's going to go up, I'm going to go buy it. Sometimes they don't work that way. Now, there's something else that I do. Gold. I get a lot of questions about gold. I am not the person that's going to go buy physical, tangible gold. That's just not for me. I see that as, what am I going to do with a piece of gold if everything hits the fan? I better buy a really sharp razor because I'm going to have to go and start shaving off pieces to go and buy some bread. But I will go buy a miner's ETF. So all of these people that mine gold, that's where I'm going to go, and I get a conglomerate of them. Again, let's go down to the holdings, and you can see Barrick Gold is in here, Newmont Gold is in here, Wheaton's Precious Metals, Kirkland is in here, and you can see the breakdown. So this is an opportunity for people to go and buy gold and have that downside protection. If one company gets hit, you are not going to get blasted, and that's something very important. Now, when we start talking about one company getting hit and getting blasted in an ETF, that takes me to Ark. You should not have an ETF that is down 50, 60, 70% in a year when the stock market is down 20%, 17%, whatever it is. ETFs are set up that are supposed to protect you with downside risk. You'll notice that when the S&P comes down, you are still having companies that are pushing you up. You're not just getting the brunt of it from Apple, the brunt of it from Google. You notice that if Apple's down 5% one day, your ETF's probably down 2% or 1.5% because it does have that weight. When you look at an Ark and Zoom or Tesla is down 10%, you are getting slaughtered on the ETF. That is not something you should be looking at. Also, I failed to mention this. When I look at S&P, the SPY, and I go and look at the holdings, go and look at some of these companies that are in these holdings. Apple, Microsoft, Amazon, Facebook, Google. These are some of the best companies in the entire world. Now let's go and look at Ark Innovation, ARKK. And I can tell you with certitude that those companies that I just pulled up, they make money. These companies here, Tesla, they do make money. Roku, Teladoc, Square, Zoom, Shopify, Spotify, Twilio, Coinbase, Unity Software. We went through one time and we looked at the top 20 holdings in Ark. 17 out of those 20 did not make money. I don't know what kind of ETF that is. That's why I say this, yes, technically it is an exchange traded fund. It is a conglomerate of stocks that help you buy multiple stocks at the same time. But ETFs are supposed to protect you on the downside. This kind of ETF is going to crush you on the downside. That is why I am not endorsing something like this. I do not think that this should even be called an ETF. It is a total scam. Now, if you would like to get into some other, you also have inverse ETFs. This is your inverse ETF of the NASDAQ, QQQ. Now let's look at the beta here real quick, 2.4. So this is a levered ETF. So what that means is if you have QQQ going up, SQQQ is going to be coming down. You notice it's down 1% today. Well, the NASDAQ, you can see, is down 0.5%. I'm sorry, the NASDAQ is up 0.5%. If you wanted to, and I'm not saying that you should do this, but if you wanted to, these are just other options of ETFs out there. I think this is very risky. If you wanted to short the NASDAQ, if you wanted to short QQQ, how much is that going to cost? Let's pull it up right here. You are going to have to put up $315 per share. If you wanted to short QQQ through this inverse ETF, it's only going to cost you $39 per share. So this is a way for you to short the market. I'm not endorsing this. I think that this is very dangerous. I don't think that you should do this based on fundamentals, but it is an option out there for you. Now, if you're trading, let me show you another way. This is how I made a lot of money. I did use these ETFs, these 3-time levered S&P ETFs. So what this means is if the market moves 1 time, this is going to move 3 times. It is going to move 3 times faster than the market. This is a great option for you day traders. I'm not saying that this is, listen, I was never in one of these stocks overnight. I only was in it during that day. But what you can do, you notice here, this thing was up. I mean, how much percent was this thing up today? This thing went from a start of $9.67 and it's now at $10.98. This is a heck of a run that you could have caught. Let's say that LABU is down. This is LABU. This is a pharmaceutical biotech ETF. When this is up, you can come and look at the inverse, LABD. And it is doing the exact opposite. The volume is exactly the opposite. The trend is exactly the opposite. So there's different ways that you can use ETFs to your benefit. Now, the goal of all of this is to tell you, SPY, VOO, those are your 2 safest bets. If you do those consistently over your lifetime, your working lifetime, you will be in a better place. SPLG, a little bit cheaper, but if you're going for options, it's not going to be the most beneficial for you in that regard. Jets, USO, GDX, they're just different avenues of you to go more sector specific. Of course, the ARKs of the world, in my opinion, stay away from them. They are wolves in sheep's clothing. And then you have these special ones, SQQQ, LABU, LABD, that if you want to have some fun and you want to understand a process of trading and go at them, attack them that way, they're a great option for you. Guys, if you're interested in picking your own stocks and not just doing all ETFs, click this video right here. Goes through options, goes through trading, goes through how to beat the market. Catch you on the flippy flop.